Good morning, everybody. It is February 15th. I'm Jane Johnson with the Briar Hill Group at Remax Camosun. Welcome to the Victoria Real Estate Show with...
Hey, everybody. It's Andrew Plank with Royal LePage, and happy day after Valentine's Day. I hope you all survived.
How are you doing?
I'm doing okay. Yeah, I was actually working last night.
You were working?
Yeah. Ended up working, wrote an offer. Very, very romantic. Very romantic. But my partner was also really busy too with her work. So we're gonna have to take a rain check on Valentine's Day. We got each other very nice cards and had a nice little bit 5 minutes of chat. Anyway, enough about that. Let's not talk about that. You got a morning happening of some sort.
Yes, I got locked out of my computer, so I am working off my laptop. This is what you call lateral thinking. And so I'm trying to figure out how to get back in. Nothing's working, so I'm hoping I'm not hacked.
Oh my God, yeah. Oh God, I hope not. Well, if you send me $1,000 right now, I will get you on.
Funny. Okay, well, let's start with the stats, and then we're going to have Mark Phillips from
HomEquity Bank.
HomEquity Bank. He's going to be talking about reverse mortgages. So we're going to figure out if that's a good option for people. And let's just get started.
Learn all about it
here. Okay. So, okay, take it away, Andrew. Whoops. First of all, I forgot. I added this at the beginning. You guys, if you like the show, please like and subscribe to us on YouTube. Don't forget to go to our Victoria Real Estate Show Facebook page and like us there. And please send us questions if you have about real estate. We'd be happy to answer them. Okay, here we go. Go ahead.
Yes, folks, we're always looking for good themes for future topics and frequently asked questions. So what has happened in the last week? It is February 15th. In the last week, we had 241 properties go live on the MLS. 111 went pending, so a little less than half, but pretty close to half. 56 properties decreased in price, so we're still seeing properties languishing on market and decreasing, although my experience in the market recently has not been that. 5 price increases, 1 property back on market, 140 properties transacted, and 36 properties expired unsold, and 6 were withdrawn from the marketplace by the seller.
Okay, and
just that to the week before. Yeah, go ahead, Jane.
No, it's okay.
Okay. So the week before, we had 275 properties go live, but only 102 went pending. So you can see that number, that ratio going up week over week. 66 properties decreased in price. So again, and then that number is definitely higher than we had last week. So again, that price the price decreases are decreasing. and price increases and so on. We don't really count those too much back on markets and so forth, these later ones. But the main ones we want to look at, new listings, pendings, and price decreases are the real key stats here when we look through this. And it looks like things are heating up.
Just interesting, well, less listings this week than the week before. So down almost 44 listings. So that's interesting to me, 34 listings. So I'm kind of wondering why, but sales are up. So that's good.
I do expect, we all expect more listings as we move into spring, and really February is still early for the spring market. So do watch for more listings and these numbers to be going up, folks. Okay.
All right. So month to date for February, so far we're at 154. That's compared to 460 for February last year. I remember February last year feeling slow. So it feels slower so far this year in my mind, but anyway, but that's up over 54 from last week, and new listings were at 400 for the month, and that's compared to 811 for the month for February last year. So we're on par for that.
On target.
Yeah.
It's a short month, so we're more than halfway through, but I do think we're accelerating in terms of the new listings, although last week being maybe an exception. I do expect we're going to see more listings coming up into February, early March.
Yeah, and we're at a total
Yeah.
of 2,186. That's for Greater Victoria. So that includes the islands up to the Malahat.
It's funny because I was thinking about this. Like, I'm working with some pretty active buyers in a couple of different categories, and we are writing offers, and we are consistently competing and losing out. And we're actually losing out to people writing unconditional offers again, which is something I haven't seen for quite some time. It's in the price point between 900 and 1.2 million. Things seem to be happening pretty fast, but there's still some older inventory that's been sitting around a while. It's starting to get picked up as this activity goes up. But anyway, we have like 1,600 realtors in Victoria Real Estate Board, and there's only 2,186 active listings, and each of those realtors is also working with buyers. And there's not a lot of inventory for the amount of agents that are actually working the market with clients, I would say.
Yes. That being said, we did a price reduction on our 7 Stillwater, which is on a large lot. It's a corner lot close to the highway, but although you can't really hear the highway. But, it's interesting doing the price reduction. We do that to bring attention to a listing because it hasn't been selling. And we try to be strategic about the price that we're going to so that we get more action. For a lot with a lot of potential, like almost a quarter of an acre, I'm surprised that we haven't had more activity. It's starting to pick up now. We've done the price reduction, but it's just interesting. So it's not as busy. You may be busy, but it feels not busy to me. So it's funny how,
our clients' urgency really helped to sort of pick up our own urgency as well. And in certain categories, I mean, we're looking more in the core. Stillwater's just that little bit further out. But for whatever reason, there's sometimes properties that are just overlooked as well. I've noticed that as well. Every once in a while, there's a rock that hasn't been turned over. It'll sell. It's going to sell.
Yeah.
Yeah. Okay.
All right. So let's bring on our guests. Do you want to introduce him?
Sure. We've got Mark Phillips from HomEquity Bank. Hi, Mark.
Hi. Good morning. Thanks for having me.
Good morning. And Mark's got lots of experience with reverse mortgages, and I'm sure many of our viewers, and we have a lot of realtor viewers as well, who aren't really familiar with this kind of product or have heard of it before, but don't really fully understand it. I have worked with a couple of clients recently who have worked with Mark, and for their particular needs, it was the perfect solution. So really looking forward to this. Mark, why don't you introduce yourself as well? Maybe tell us a little bit about your own background and time.
Yeah, sure. So I'm here in Victoria. My territory is all of Vancouver Island. The company I work for is called HomEquity Bank. We're the providers of the CHIP reverse mortgage. The company's been around for 38 years now doing reverse mortgages, only in Canada. My background is, let's see, I got started in finances on the investment side. Back in 2003. And then I swapped over to the mortgage lending side in about 2008. And I've been doing that ever since. So I came to this company 8.5 years ago. After in my previous role, I was sending a lot of clients over to my predecessor in this role. And I really saw the value. It's interesting. This is a product where it is just a mortgage, but for the clients that we're dealing with the demographic, with some of the problems that they run into, and obviously we'll get into that a little bit today. This is, you do a regular mortgage for maybe a first-time home buyer, and it's really rewarding. This product is life-changing for a lot of our clients. So it's very rewarding. Yeah.
So is the premise of the reverse mortgage, they take the equity from their own home, they're borrowing against themselves, essentially?
Yeah, exactly. So let's jump right in. So it's funny. Reverse mortgages are a very sort of misunderstood and a much maligned sort of product. There's things that go down in the States that just don't happen here in Canada. The mortgage itself is very simple, and that makes my job easy. So we are a Schedule I bank, just the same as like BMO or TD or any of the rest of them. the regulation that we are under is just as like there's a lot of scrutiny, obviously. The mortgage itself is just the same first conventional mortgage as if you were to walk into your bank and say, I'm buying a house, I need a mortgage. Exactly the same thing. The two main differences are we don't use income to qualify somebody for how much they can borrow. We use the value of the home and the client's age as our guide, and we'll get into that as well. And then the second main difference is that we don't require payments to be made. So it's a mortgage that actually grows in value over time rather than reduces in value because no payments are being made.
Well, it grows in debt.
Yes.
The mortgage balance grows. Yeah, exactly. Yes. So the basic premise is the maximum loan to value that we can lend is 55%. So $1 million home, the maximum we can ever give is 55%, $550,000. But in order to get that much, a client would have to be in their mid 80s to get. And the reason for that is we don't want them to run out of equity. So our average loan to value across all mortgages, as long as we've been in business in Canada, is about 32% loan to value. So on $1 million home, $320,000, okay? Average age is about 72 years old. So a 72-year-old borrows $320,000 from us on $1 million home. For our typical illustrations, we'll use a 3 or 4% home growth factor. You two would know better than me what the average is in Victoria for all time, but it's somewhere over 6% from what I can tell. So they have $1 million home growing at an average of 6% per year, and they have a $320,000 mortgage growing at, right now, our 5-year is 6.89%, and we're still in the pretty high rate range. Mm-hmm. So $1 million home growing at 6%, $320,000 debt growing at 6.5%, whatever. That debt never catches up. So the client can comfortably live in the home for as long as they probably will live in the home and not run out of equity. And that's the premise of the whole thing.
So
6% seems generous right now for growth.
Yeah.
Today it is. Yeah. From the stats, I mean, obviously I get this question a lot. The stats that I've looked up in because equity preservation is a big part of our underwriting and our decision making. Yeah. I've looked back up as far as I could go in the Victoria Real Estate Board. And it looks like this was at the June of last year. It looks like the last 60 years was about 6.24% from what I could gather. And that's sort of my rudimentary math, but yeah.
Mm-hmm. So how does a person approach you or get in touch with you? What have they gone through previously before they decide to get into business with you?
So I work with mortgage brokers on Vancouver Island. So I support brokers. Sort of as a spin-off of that, I tend to work with a lot of realtors because realtors and mortgage brokers work together in most cases. So generally what will happen is a client will have a need for whatever reason that is. Maybe they're buying, maybe they're downsizing, maybe they have some debt that they're in retirement, they're on OAS and CPP, maybe a small pension, and for whatever reason, they still have debt. And they're struggling to make those payments. I mean, inflation, we don't have to talk much about the burden that's mm-hmm. had on all of us lately. Mm-hmm. We're seeing a lot of people who simply can't afford their property taxes, their strata fees, their insurance, their food bill, and their debt payments on top of all those things. But they might have some home equity. They own their home and, they live in Victoria, they've won the home lottery kind of thing. So somebody will go to a mortgage broker and say, look, I need to do something. I need to refinance my mortgage. I need to lower my payments. What can you do to help me? And with very, very few exceptions, mortgage lenders, the first thing they'll look at is income. Okay, let's look at your income and see what you can afford to make payments on. So a lot of people will say, okay, first choice will be, let's look at a home equity line of credit. You only have to make interest payments. Well, first of all, this client that we often see might not be able to comfortably make interest payments, even if it's a low payment. And I'll give you an example of an average client that I recently worked with. But they probably won't be able to qualify as well, right? There's the stress test involved in that. And somebody who's on just OAS and CPP might not be able to qualify. I'll give you an example of this. Just a couple of months ago, I had a really, really nice client, and it was a great outcome in the end. She had a mortgage of only $90,000 on a $750,000 condo, and it was coming up for renewal. Her old rate was, 2.5%, and her monthly payment was like $300. And it was tight, but she was managing it. She had a dog and a cat. It came up for renewal, And the credit union that she was working with, her rate was going up to 6% or whatever. Her payment was going up to nearly $900 a month. And we're seeing a lot of this right now. This is pretty normal. She actually, when she came to the broker, he asked me to come and meet with her because she was, obviously really stressed out and worried. She actually had gotten to the point where she had looked into adopting out the dog and the cat because she couldn't afford to feed all three of them. And so anyway, long story short, it was a really, really simple with, $750,000 condo, only a $90,000 mortgage. We got her a chip reverse mortgage. We were able to get her, a little bit of extra money there was a few things around the house that she wanted to do. And now she has no more payments and she can stay in that condo for as long as she wants to.
Go ahead, Andrew.
2 questions.
Yeah. Well, and that's a similar, you worked recently with a family member of my own and one of my clients as well. And that for the family member, what had happened was there had been a regular income that had dropped off. It was a annuity that ended. And so so her income dropped. And she had a mortgage on her condo, similar value condo. And so what we were talking about is how long does she get to stay in this condo that she loves when things are getting really, really tight versus selling it and buying her something smaller she won't be happier in, or selling it, renting something else, and then the equity going, or her going into some sort of assisted living. And at that point, just, selling her unit, going into assisted living, but then that is so expensive. She'd be going through all of the equity that we'd gotten from realizing the sale of her home, and her home wasn't going up in value anymore. We talked through lots of options. We talked about perhaps moving her into a place and renting out her unit now that you can rent out units. But again, then the math just didn't add up. So by bringing in the reverse mortgage, now suddenly she doesn't have a mortgage payment to make. And one thing you'll probably talk about is the other thing she can do is she got approved for a certain amount for this reverse mortgage, but she's not paying interest on the full amount yet because she can draw from over time to get up to that max. So right now she was able to pay off her mortgage and stop her mortgage payments themselves with the home equity line of credit. So that freed up money right there. And then she also can draw as needed as she builds that up. In the meantime, her unit, on average, hopefully goes up in value to equal or better that difference that she's paying in a higher interest rate than you would on a normal conventional mortgage. But it's still, when we did the math and looked at all, it just was the best option possible.
Yeah.
I just have a question. How does this show up on the title when somebody has it?
Just like a regular mortgage, because it is just a regular mortgage. No different.
Okay. And then do you consult with other family members? Because I'm just thinking, I'm just wondering about people who maybe not be corpus mentis.
Yeah, we actually, that happens all the time. And we regularly can, work with power of attorneys, things like that. Every case is different. Some people say, my kids have, this isn't their decision. It's none of their business. Others say, yeah, I'd like to make sure that my whole family understands what's going on. And so every situation is different. And
you do also insist on the person getting this mortgage getting lawyer's advice, because that was something we had to go through as well.
Yeah, every single one of our clients gets independent legal advice at the end. So that's something that is separate from us. It's the client's own lawyer. They choose who they use, and they go, and that person makes sure that they are of sound mind and they understand the documents that they're signing.
Yeah, I do think it's important to get the family involved, because I think that suspiciousness that you were talking about will come out if you don't. I think it'll be preventative. It's a preventative measure to help educate everybody. So
yeah, and now, so there are steps. So one of the things that we often do is parents or grandparents pulling equity out to help younger generations get into the housing market, and that's a huge part of our business. And so we do actually take steps in our process. If somebody has 2 children, but they're giving money to 1 children, we want to make sure that, okay, well, what's happening here? Is that other child going to be calling us saying, hey, I'm going to court because you convinced my parents to take money out of their house to give to my sibling, but not to me. And so, we have to be careful in those. So yeah, obviously we want to be as open as possible, for sure.
We have a question from Danielle. If someone is elderly and has a house, wouldn't they be better off selling and then renting and investing the money?
Honestly, it depends on your situation. Where are you going to sell and rent to? Like where are you going to move to? So one of the things that we look at quite often is, if you have a house in Victoria, what, $1.2 million, whatever is our average home size. You want to sell that and then move into a condo. So you're downsizing. Okay. What are the actual costs of downsizing? And do you want to? So maybe financially, that's not a bad idea. I will say, and I don't know that we're going to have the time to go into it, I have a lot of numbers that support that isn't necessarily the best financial choice, and there's better options. I just don't think we're going to get to go into that there, and I'm happy to take that up with anybody who wants to talk about it.
I think
a few years ago, RBC did a survey across Canada. 93% of Canadians said they wanted to stay in the homes that they're in right now. You think about downsizing and leaving the community you're in as a senior, you're in your 70s and you're looking. So we split retirement into the go-go, the slow-go, and the no-go years, right? So you're 65 to 75, you're enjoying retirement, you're traveling, you're out, you're not worrying too much about downsizing at this point. Then there's the slow-go years, right? Things are slowing down, you're not traveling as much, you're staying in your neighborhood. Those are the years where people start to look at, like, maybe it's time to downsize. But when you get to your no-go years, what happens to, like, your doctors, your neighbors who help you out when it snows and they shovel? It's not a big problem in Victoria, I guess, snowing, but like, I know in my neighborhood when it snows, I'm the guy out on the block shoveling all the sidewalks for everybody because I'm the young guy. If we don't see our neighbors out for a few days, we might go and check on them, things like that. So people want to stay in their homes. So while there may be some, like some relief in terms of debt for downsizing, where are you going to go? What can you afford? Is it the lifestyle that you want to have? And most people say that's not what they want. They'd rather stay in their homes.
I think one of the fears is that somebody just looks at it as a bank and just starts drawing on it too quickly. So, and runs out of money. And so, like, yes, they have a mortgage of, $350,000 on a 1.2 million place. And they run through it in a couple of years and they start running it down. Yep. I think the question comes from that, as well as the maintenance. So she just had a further question. Sometimes seniors can't stay in homes and maintain them even though they want to, and it's because of the cost of just of living. And I know in this case, and in some cases with heritage homes downtown, there are big costs that come up, right? Like a new roof.
Sure. Look, every situation is going to be different. I'll give you another story about a client of mine. These clients, I should say, there's a couple, they live out on Lochside in North Saanich. When we did this mortgage a couple of years ago, their place appraised at $2.5 million. It's a 25,000 square foot lot, waterfront, huge blackberry bushes that grew on the embankment in front. They had to have gardeners coming in weekly. Big house, they had house cleaners as well. These clients are closing in on 80 years old by now. They had OAS, CPP, both had very small British pensions. They still had a mortgage of a couple $100,000 left on their home. It was actually in the line of credit, so they're only making interest payments. They still were, they wanted to travel, they wanted to see their grandkids, things like that. But they started selling off like RVs, boats, things like that, so that they could pay to stay in their home and take care of this home. Because as they said, we're going to be carried out of this place. We don't want to leave. And that's honestly, I mean, this is my job. I deal with these people all day long. This is what people do. And so for them, that was really easy. On a $2.5 million home, we were able to pay off their existing debt. They wanted a new heat pump. They wanted an electric car. They were able to use the electric car. And they take $2,000 a month out of the value of their home. So we can set it up that way. So they would have been approved for, over $1 million. I can't remember exactly what we set the mortgage up for, but they took a $200,000 initial advance, or just over that. And then they take $2,000 a month, goes into their bank account. And so they can keep the cleaners, they can keep the gardeners. right?
And that's set, so they're not able to.
Yeah.
They would have to go through extra steps to go and get extra money. They've set it up so that they know what they're going to be costing every month and so forth. I mean, you can get a home equity line of credit and go through that in no time as well. It's there is some responsibility for being self-responsible when you use these products.
And I'm just going to say one other thing to your last question, Jane. What I find is, I would say probably 75% of all the mortgages that I do, people require the maximum we can qualify them for.
Yeah. So, I'm just at the end of the day, though. So we have. I appreciate that you loan to 55%. I think that's smart, because at the end of the day, let's say the market dropped, which it has dropped in the past 2 years, more to, I would say, where it was pre-COVID, where when somebody goes to sell, they're paying out a mortgage. My dog is talking. When somebody goes to pay out a mortgage, obviously this is going to be the first mortgage. It's going to be growing in amounts over time. So I'm just wondering, I guess you just paid out like a regular mortgage.
Just like a regular mortgage, yeah.
Yeah, it really speaks to talking to the family, though, so they're not surprised that there's a mortgage on the property.
Again, different situations. I would. You'd be surprised, actually, how many people tell me it's none of their business. So
the family's business, none of
and
that's true. I mean, we get in other cases,
in other cases, we have the family super involved. I mean, Andrew's a testament to that. So, and other advisors too. We regularly have the financial planners involved in these situations. So, but I will say, James, to your point there, when people sell, and it has been an increasing value mortgage. So it sounds like a made up stat when I say 99.5%, but it's actually true. And we've been doing it for 38 years. 99.5% of all clients have more equity when they pay out their mortgage than when they started. And that is for the simple reason that our loan to value is so low that the growth of the big asset hugely outpaces the growth of the small debt. And that's just the way we underwrite. So
the interest rates are higher than a standard, more conventional mortgage. But that's because you're not making payments, and it's still not, it's not usury. You're not paying 20%. You're paying a few percentage points above what you might pay on a traditional mortgage, but you're not making those payments.
Yeah. And one of the, there's a few of sort of our standard, like, reverse mortgages are bad, they take your house and things like that. Well, that just doesn't happen. We're a bank.
You guarantee that now, right?
Good. Yeah. Yeah. Even if we thought that was good business practice. Yeah. But one of the things is, the rates are so much higher than regular mortgages. Well, you know what? Our rate right now is actually lower than a HELOC rate. So if you go to your bank and get a home equity line of credit, our 5-year fixed rate is lower than the HELOC. So the argument that our rates are so much higher, it doesn't really hold a lot of water right now. Andrew, I'll finish your question first before Jane. So one thing that you asked, so we have something that's built into our mortgages. It's a no negative equity guarantee. So let's say we had our average client, $1 million house, $320,000 mortgage, and they're going along for a few years, and then something terrible happened on Vancouver Island where suddenly nobody wanted to live here. The housing prices dropped, interest rates went to 15%, and a few years down the road, their mortgage was underwater, and for whatever reason they left the house. We take the loss on that. The most we can ever ask for back is the fair market value of the home. So in the case that a mortgage did go underwater, which literally they just don't, because our underwriting is so conservative, then the best advice to the client would be to stay in the house as long as you can. We're never going to call the mortgage. You can stay in that home. And when you do have to leave for whatever reason, that's our problem, not yours.
Yeah.
Okay. The question I have is, do you do continual appraisals over time? And how long does your loan last? Like if somebody is borrowing $500,000, is it like a 20 or 15-year timeline for the loan, or?
So it's forever. So our term, it's hard to understand, especially when I talk to mortgage people, because our term is different than everybody else's term. The term is a forever term. So when somebody sets up a mortgage against their place, it will run for as long as they live in the home, if they want it to. Okay. We offer interest rate guarantee periods, so people can choose a 1 year, a 3 or a 5 year interest rate or variable, but the actual mortgage stays on the property for as long as they want it to, and as long as they live in the home. Okay. We do reappraise the homes every year, but that's only for our own internal information and for capitalization requirements as a bank. We don't, we don't call up a client and say like, oh, you know what, your house value went down. We're going to claw back some of that mortgage. That's not it.
Mm-hmm.
We have a commitment that we sign with the client at the start, and we hold by that commitment.
So two questions, because you mentioned prior to the show something about a bridge open or something, and how you can help realtors with or people with getting ready to sell a home to buy.
Yeah.
And the other thing is, and just going back to requirements, like you said, people can live in the home forever and so on. As I recall, you have to stay living in the home. You can't sell it right in the first year or something like that, unless, or there were some penalties to some things.
Yeah, so our product is designed as with the exception of the chip open, which I'll talk about in a minute.
Okay.
Our products are designed as the sort of overriding goal of our product is to keep people in their homes as long as possible. And so it's designed as a long-term product. In the first 3 years, there are heavy penalties to pay it out. When I say heavy, it's pretty much in line with any other 5-year fixed rate mortgage, what it would be.
Right.
In the first year, it's 5% of the balance to pay it out. Second year, 4% of the balance. Third year, 3%. Now, that said, the reason those kind of don't matter is because none of our clients ever pay us back in less than 5 years. 1% of all of our clients pay us back, excuse me, in less than 5 years. Our average client is with us for just under 12 years. And so that's the way we underwrite. If somebody wants a shorter term mortgage, we do have the open product, which is much more suitable for, for shorter term financing. So,
Okay.
And again, conventional mortgages have the, what do they call it again? The interest rate differential,
yeah.
Which is a huge penalty as well if you pay out early.
Yep. Yeah, it actually kind of works out to be just about the same.
So what are you looking at? What are you offering right now for percentages?
Right now, our 5-year fixed is 6.84. I think that's the 5 years our lowest rate right now. So
okay.
So we're generally a couple of percent higher than what you'd get, if you were an A client. If you went into TD or Scotia or something like that, we're generally a couple of percent higher. So, but again, we're not lending. So
no income
to your clients who can qualify for and comfortably make payments on a regular mortgage. Probably we're not for them. That's not who we're working with here. But to clients who are retired on a fixed income or approaching retirement and don't want payments or can't comfortably make payments or can't qualify, that's where we fall in. We're in a different category of lending. So, but we're certainly cheaper than the personal lines of credit or the credit cards, auto loans, that sort of stuff, right? So, we're a little more expensive than A lending, but the clients that we work with aren't. They're not getting A lending. So
fair enough.
Yeah.
Okay. So we're at time. Thank you so much for coming, Mark. I really appreciate it.
Let's let him finish about the bridge open.
Sorry.
Before we go. Yeah.
Sorry.
Yeah. Okay. Yeah. I'll quickly try to do that for any of the realtors that are listening. We have an open mortgage, and what we use it most for, and the reason it was created, is we're getting a lot of calls from realtors and mortgage brokers saying, look, I've got these clients, they're in their 70s, whatever. They want to move or downsize, but they want to take advantage of buying the place now and not having to move all of their possessions on the closing date. They won't want to line up the purchase and sale. They've got a free and clear home worth $1.2 million. They want to move into this $800,000 condo. Can you get us the financing? And we can. We could do inter alia over the purchase and the sale, and we could fund 100% of the purchase. But as I said before, the interest penalties are quite steep in the first year or the first 3 years to do those. So we created this open product, which is basically, it is just a totally open mortgage. And a client can do inter alia over 2 properties. They can actually do over any number of properties, but typically what we're doing is we're taking security on their existing home, security on their purchase, wrapping that all up, getting them a mortgage, which in most cases can fund 100% of the sale price or the purchase price. Then they can move in, take time, move all their possessions, clean up the home, list it, sell it, maybe realize a higher sale price, if you're looking at market timing, that sort of stuff, and then pay us back when they're done. Or they don't have to pay us back all of it. They can keep some of it based on the new property. So,
or if they have an older home, that's really good. If they have an older home, they're getting it prepared to sell, their realtor, or they've had suggestions that they should, you were mentioning the brambles, all the, getting some landscaping done, maybe getting some updates done in the house before they sell it. That frees up some money for that to improve it.
Yeah. We've used it in a lot of cases where, I mean, I'll be honest, our demographic, there tends to be some deferred maintenance in a lot of these properties. And so, you borrow $60,000, you whatever, fix up the carpets or the roof, do some landscaping, clean the place up a little bit. You're probably going to realize an exponential return on that investment.
So what's for an inter alia mortgage? Let's say they have $1.2 million home or $1 million home, and they buy another $1 million home, and they want the inter alia mortgage. What's going to be the cost of that over, let's say, 3 months?
Okay. So I guess it depends how much they need to borrow, obviously. The fee to set it up is 1.25% of the mortgage amount. So the reason we set that up is because kind of the next option, if a client can't go to their regular bank and do it, and anyone who's in mortgage lending land knows bridge financing is virtually impossible unless you don't even need the money. That's when you get approved for bridge financing. So the other option is to go to a private mortgage. So there's plenty of private lenders that we could talk about here. Generally, the fees for that are going to be somewhere between 2 to 2.5% to set up a private. Okay, so we set it up at 1.25%, which is considerably lower, and then the interest rate is prime plus 4. So again, the interest rate is quite steep on this, but if it's only for 3 months, the difference in cost savings there between going to a private and paying a 2.5% fee on $1 million mortgage and a 1.25% fee on $1 million mortgage. For 3 months, who cares what the interest rate is? I could tell you it was 20%. It would still be a bargain. Not a bargain, but you'd still be saving money. So
it's all about what you're trying to accomplish and what's it going to cost you to get there, and which is the best option for you at that time. And
absolutely,
this is a product that may work for some people, may not work for others. As you said, some people have other options they go for, but if you don't have other options, this does actually free up some ability to move. It certainly, for my other client, freed up the ability for her to sell her to make an offer that was not subject to financing, or at least not subject to the sale of her home. It was subject to financing. Not subject to the sale of her home when she had a tight timeline for getting this offer accepted, and then be able to close on it and then move in, as you use that example, move in with a bit of a gap. So it worked really well.
It's a cash flow issue.
Yeah, exactly.
We are 100% a cash flow play. Yeah. In every sense. Yeah.
Anything you want anything we haven't covered, Mark, before we go, because we should wrap this up. But
I would love to get into the proactive downsizing. I don't know. I mean, maybe we talk about that some other time. It's a bit of an in-depth concept. It's something that we have been doing a lot of lately. Jane, you talked earlier about somebody who wants to downsize. That was one of the questions that we got, is downsizing. And I can show the math about why, if somebody wants to downsize, buy your place now, if you're planning on downsizing 10 or 15 years from now, and generate rental income from that. And it's kind of a long and in-depth story. If anybody wants to talk about it, get the idea, I'm open to a call sometime. Maybe we can go into it at some point in the future.
Sounds like you're talking leveraging a second purchase, and what we suggest for anybody who's looking to improve their real estate. But let's go into that another time.
Yep, absolutely.
Sounds like a great conversation for another time.
Okay, how do people get in touch with you, Mark?
Yeah, right there. They can call me. My cell phone number's up on the screen there, it looks like. Or
can you read
email.
It out?
Yep.
Can you read it out?
Oh, sure.
Read it out just for, there's some folks who are listening only. So
of course, 250-812-8629. My email is markphillips@heb.ca. Mark Phillips with 2 L's, and that's HEB like HomEquityBank.ca. So open to talking with anybody who'd like to talk about it.
Okay, I have your email as mphillips@heb.ca. Is that correct?
Isn't that what I just said? Did I say something different?
You said Mark Phillips. Just want to check.
Oh, I'm probably just reading the screen in front of me. mphillips@heb.ca. Yes.
Okay, awesome. Thanks so much for joining us. I really appreciate it. I've learned a lot.
Okay, my pleasure. Thanks for having me on.
Thanks for coming in, Mark, and really appreciate that. It's really helpful for everyone.
Okay, talk to you later. Bye-bye.
Bye-bye.
Bye, everybody.
All right, let's just get back to the show here. Andrew, do you have any real estate needs and wants?
I really, really need a home around a million. I've got a home. I've got a roof over my head. But for some clients, $1 million plus or minus, fixer upper fine, space for additional family down below, but does not need to be a suite. Just needs to have comfortable space with a bathroom on the lower floor, plus living area up. And preferably in the Gordon Head kind of area, Saanich East kind of area, but they're also looking in Saanich West. In fact, today we're going to be going down to James Bay to look at a place. So a little broad there, but that's one thing we're looking for. Also still, and we wrote an offer on a place in the $2 million range in Oak Bay for this family, this other family, but we ended up competing and losing out. We would love to find something that's just a great updated family home in the 2 million range. We'll be out with an out-of-town buyer next week, looking at townhouses in Sydney and the Peninsula, and even Broadmead, Royal Oak area would be great. Under 1.2, preferably closer to under $1 million. Must have a fireplace and must have a bathtub in the, preferably a bathtub in the ensuite, but doesn't. We'll put it in if we have to. Anyway, just a nice, newer, cleaner, not newer, a nice, cleaner, older unit, actually. She doesn't want brand new.
Okay, well, I consider showing my unit on my house on Stillwater. It meets all your criteria, but except for the neighborhood. But it is an awesome neighborhood. It's right by parks, and it's also really handy. It's close to the Galloping Goose Trail and highway. It's super central.
I'll highlight it for them. Yeah.
Okay. I am going out with a buyer next week who's coming in from out of town. We're actually looking up at Mill Bay to Cobble Hill. So if you have something that isn't listed yet, let me know. We're looking at everything. We've already approached the realtors, and I have a new listing coming up. It's 2-bedroom, 1-bathroom on Nelthorpe. It's a townhouse. We're going to be listing it at $650,000, and that's very well maintained by its owner. So all the living spaces on the bottom, 2 bedrooms and 1 bath upstairs, and it's updated. And what else? We have some other properties, but because of the new rules, I can't tell you they're coming up for the market. So just stay tuned to this channel, please, and follow us on our social media for things that are coming up. Andrew, how do people get in touch with you?
Yeah, 250-360-6106, text or phone, and email is info@andrewplank.com. And of course, the website andrewplank.com has a number of resources and all the contact information there as well. I'm also on Instagram under Plank Andrew, where you'll find other stuff. So.
All right. And if you want to reach me, I'm Jane Johnston. My number is 250-744-0775. My email is briarhillgroup@gmail.com. You can visit me on my website at briarhillgroup.com. And if you want to look at these videos and more, you can go to victoriarealestateshow.com. Also on Instagram, I'm at realtyteacher_remax_Victoria, or we have a new Instagram at Briar Hill Group. So please get in touch with me that way. And don't forget, we are on every Thursday at 9:30. So we'd love to hear from you. If you have questions or comments or anything that you want to discuss, please let us know. Andrew and I are both open to covering lots of topics. Thanks for the suggestion today. That was really interesting.
Great. Thanks, Jane.
Okay. See you next Thursday.
All right, everybody.
Bye.
See you next Thursday, Jane. And thanks everyone for watching.